As Canadians, one of the complaints we have is that we never find good deals on cellular and internet plans when compared to the south of the border. The main reason for that is there is no much competition here. Now, for us as an investor, that makes it easy. You can blindly invest in telecommunication stocks. Sort of. Hi, welcome to my channel, and in today's video we will compare the three main Canadian telecommunication stocks. Bell Canada Enterprise Inc. (BCE) is the Canadian holding company for Bell Canada, which includes telecommunication providers and various mass media assets under Bell Media Inc. It is one of Canada's largest corporations and Canada's largest communications company. They have three primary divisions: Bell Wireline, Bell Wireless, and Bell Media, providing services to residential, business, and government customers throughout the country. 52% of the revenue is from wireline services, that is, phone, broadband, and cable. 38% from wireless, and the rest from media. Let's look at how the stock performed for the past 10 years. If you look at the chart, from 2011 to end of 2017, it was a proper growth chart. There was a bounce back after each dip. For example, there was a dip after the heights of May 2013, which resulted in an upward trend till June 2014. Then again a dip till October, but then bounced back, which continued till February 2015. And this trend continued till 2017 December. The year 2018 was not a good year for investors, but the stock gained momentum by the end of 2018, and that continued till COVID. It took almost a year for the stock to recover from the COVID losses, but the year 2021 has been really good so far. From the 2020 annual report, 2020 was not a good year for BCE. As you see here, for all these data points, 2019 was better than 2020. But since we are already in the last month of 2021, it's better to review the third quarterly results. Operating revenue was up 0.8% over Q3 2020 to 5,836 million. Net earnings increased 9.9% to 830 million, and net earning attributable to common shareholders totaled 757 million or 0.83 per share, up 9.4% and 7.8% respectively. However, cash flows from operating activities were down 15.9% from Q3 2020, mainly due to a reduction in cash from the timing of working capital changes and higher income tax paid. Some of the highlights of BCE for the last quarter are: they had 136,464 mobile phone net subscriber activations, that is, it's up by 14.3%. 65,779 retail internet subscriber activations. This represents the best quarterly performance in 15 years. IPTV net subscriber activations increased 10.2% as well. BCE is a very good dividend yielding company. The current dividend yield is 5.22%. They pay dividend quarterly. For the year 2021, the payments were $0.875 per share, which annually is $3.50 per share. The second company is Telus, ticker T. The company is based in Vancouver, British Columbia. It was originally based in Edmonton, Alberta, before its merger with BCTel in 1999. Telus Corp was formed in 1990 by the government of Alberta. It is the second largest telecom company of Canada. Telus Corporation business structure spans across two major divisions: Telus Technology Solutions, revenue from mobile technologies, internet protocol, televisions, cloud-based services, smart technologies, healthcare, etc., and digitally led customer experiences, Telus International or DLCX. which builds and delivers next-generation digital solutions to enhance the customer experience for global and disruptive brands across multiple high-growth industry verticals. The year 2021 is proving to be a better year for Telus compared to year 2020. There is an increase in the net income from 33 million in quarter 1 of 2021 to 358 million by quarter 3. Total customer connections has also been increased at a fixed rate throughout the year. For the operating revenue, Telus Technology Solutions reported a profit of 4.1% compared to last year's quarter 3, whereas DLCX reported a 23.2% increase. We can also see an increase in EBITDA for the quarter 3 of 2021. If we look at the last 10 years chart for Telus, the pattern is similar to that of PCE. A dip is always followed by a considerable bounce back, and that rallied for years. A good growth chart that encourages investors to buy more during dips. Currently, it is at an all-time high, but based on the trend, it will go up in the coming years. And also, since now Telus is moving towards healthcare sectors and more technology-based solutions, I believe the value of the stock will definitely increase. From a dividend perspective, Telus is planning to target ongoing semi-annual dividend increases, with the annual increase in the range of 7 to 10% from 2020 through to the end of 2022. The current dividend yield is 4.21%. They also pays dividend quarterly. For the year 2021, the payments were $0.316 per share for the first 3 quarters and $0.3274 for the last quarter. That makes an annual dividend of $1.27 per share. Payout ratio is 132.08%. Rogers Communication Inc. is the third telecom company in our list. They span wireless, cable and internet, mass media and to the ownership of Toronto Blue Jays. They are headquartered in Toronto and the primary competitor is Bell. Both these companies have strong hold in the eastern and central Canada. Recently, they have acquired Shaw Communication, which makes them a player in Western Canada as well and put them straight on head with Telus. They have a diversified revenue streams where 61% of the revenue is from wireless and 28% from cable. For the quarter 3 of 2021, they have wireless postpaid net subscriber addition of 175,000. Wireless service revenue growth of 3% mainly as a result of larger postpaid subscriber base and high roaming revenue, as global travel restrictions were generally less strict than last year at the onset of COVID-19. The adjusted EBITDA was up by 2%. Increased cable revenue by 3%. So overall, if you look at the results, apart from the service revenue and cash flow from operating activities, the rest of the data points are in negative. They have a negative quarterly earning growth year over year and a total revenue was stable. Media revenue decreased by 3% this quarter, primarily as a result of the NHL and NBA completing their seasons late in the third quarter last year due to COVID-19, when traditionally they concluded in the second quarter, partially offset by higher Toronto Blue Jays game day revenue as COVID-19 restrictions eased and partial fan attendance was permitted. The talking point for Rogers this year was that Rogers reached an agreement with Shaw Communication Inc. to acquire all of Shaw's public share for a price of $40.50. This transaction is valued at approximately $26 billion, including the assumption of approximately $6 billion of Shaw debt. Another reason why Rogers was in the news this year was the ongoing court case for the battle of the control for the company. Edward Rogers, the only son of company's founder Ted Rogers, was chair of the board at Rogers Communication Inc. In September 2021, he attempted to replace the CEO Joe Natale with company's chief financial officer Tony Staffieri. But other family members and board were on the opposite side and they voted him out as chair. So he used his power as head of the voting trust that controls 97% of the company's voting shares to fire 5 members of the board, replace them with his hand-picked choices and reinstate himself. Now, a British Columbia court has ruled that Edward Rogers is the legitimate chair for Rogers Communication Inc., a major legal victory in the battle to take control of the company. Now, for investors, this does shows a sign of instability within the family and the board. If we look at the last 10 years chart for Rogers, again the pattern is similar to that of BCE and Telus. However, from 2019 onwards, it gives a different picture. The stock was already going down and the pandemic made it worse. It took some time for the stock to bounce back, and currently the price of the stock is at that range where it is underperforming. I consider this a stock for an investor who is ready to take risk. There is a huge potential for it to grow to the previous highs of $70 or $80, but there is always that question mark. The current dividend yield is 3.42%. They pay dividend quarterly. For the year 2021, the payments were 50 cents per share. That makes an annual dividend of $2 per share. The payout ratio is 63.09%. If we compare these three stocks, Rogers shares have lagged behind those of rivals Telus and Bell for most of the pandemic. And the company is worth about the same today as it was in 2017. The current quarterly results are also not promising. However, when we look at the fundamentals, mainly comparing the 10 pillars that make or break a company, Rogers have an edge over Telus and Bell. However, based on the recent results, Telus is way above the other two. So, what is the verdict? For me, Bell and Telus are the safest bet. Bell is a very stable company with a great dividend yield, good for passive income. Telus, on the other hand, is a fast-growing company with a lot of diversified sectors, focusing more on technology, one that have a huge growth potential. Rogers is a giant of a company, and with Shaw deal and the right policies and decisions from a unified boardroom, it can achieve a lot more. I see this stock for an investor who is ready to take a bit of risk. It is now trading at a discounted price, so with risk comes greater return as well. So that's my take on our telecom sector. I do have BCE and Telus in my two different portfolios, and I may also add Rogers into it. Hope you like my take on this. If yes, please like, subscribe, and let me know your thoughts. Cheers.